Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Tom Laune with Stress-Free Planning and the mastermind behind the Bulletproof Wealth formula. Is that what is it? The formula?
Yeah, it's strategy. Thanks, Lance.
Strategy, yeah, exactly. So I had met Tom at a conference last month, and so we got to talking, and he was sharing a little bit about. He's also the sponsor of the event, as were we. So we got to talking, and he's got a really fascinating sort of strategy here that I'd reckon that most of you aren't familiar with. So figure we have him on the show to talk about this. A little different than maybe what we are typically covering, but I think Tom's got a great story and probably some really great nuggets for many of you out there. So Tom, why don't you share a little bit with us sort of how you ended up getting into this and developing, I guess the stress-free planning, and so the whole planning side of things. What was that path like?
Oh, thank you, Lance. I'm so excited to be on your show, and I am looking forward to really going into a little bit of how the Bulletproof Wealth Strategy that I developed works. So it started where for 29 years, I was a music professional, believe it or not. I know that sounds crazy, but I was a production recording engineer and mixer, and I got to work on a lot of really high-level artists like REM and Bruce Springsteen and Fabulous Thunderbirds and movie soundtracks. I mean, just all the list just went on. I worked with hundreds and hundreds of artists over a 30-year period. And the interesting thing is, about 20-something years ago, I had a financial advisor say to me, "Hey, Tom, you need to get some disability insurance because your job is very specific and unique. And if you lose your ability to do it, then you're going to be hosed. If you can't hear great at some point in the future, then you're going to be in big trouble." So I bought this thing, Lance, called an own occupation disability policy that was specifically on my hearing, so that if I lost hearing and wasn't able to do that very specialized job, it would pay for me to learn a new career. And I thought, okay, I'm gonna do it because I don't know, and it's a possibility. And I found out later, Lance, what a huge possibility that was, because fast forward 20 years into the future, and I'm working on a movie, and sure enough, I had an accident in the studio, lost partial hearing in my right ear, and was really unable to do that fine job. It's sort of like being a painter and you can't see color perfectly anymore. It's a real problem. So I ended up using that particular own occupation disability policy, which these types of things work amazing for physicians and anybody who has a real specialty skill as well. But I ended up using that and taking this 5-year time where I had tax-free monthly income coming in every month for 5 years, and I went back to school and got 3 financial designations so that I could really learn what I was doing, because I wanted to help people like this gentleman had helped me. And I was like, wow, this is absolutely amazing. If I didn't do this, my family and I would have been in huge trouble. But with this one critical thing, I was able to really take a deep dive and I got a chartered financial designation. I got a chartered life underwriter designation, and I got a chartered special needs consultant designation in that time frame. And I then was able to really experience the entire breadth of what's out there in the financial world. And that is basically the foundation of how I developed my strategy. So it was really cool.
Yeah, that is. It's always interesting when you're like, okay, yeah, that I'll get that policy, and you keep making the premium payments. You're like, oh man,
Yeah, 20 years.
money down the
And Lance, I'm telling you, man, I was in my 20s, but I was making a very, very good living because I was doing very high-end work. And so I qualified for a pretty big policy, but with a pretty big policy for a 20-year-old in the very early 90s, that was, I mean, not 20-year-old, but a mid to late 20-year-old in the early 90s, it was like $570 a month or something that I paid on that thing for 20 years. And back in the early 90s, that was quite a bit more money than it sounds like today to be paying for every month. But it absolutely made all the difference. So let's just fast forward, because in my music career, Lance, I ended up becoming really interested just as a hobby in economic theory. So there's multiple schools of economic thought. There's the Keynesian school, which is predominant, what we're operating on now. There's the Chicago School of Economics, and then there's the Austrian School of Economics. And that was the one I was most drawn to because it was centered around sound money theory. And I went to hear an Austrian economist named Robert Murphy speak. And I thought, oh, this is going to be great because I'm really interested he's a full PhD Austrian economist. And he was talking about this strategy that I've never heard of called infinite banking. And infinite banking is basically where you combine a life insurance policy and a savings account type vehicle together to have a unique place to store capital. And I combined infinite banking with some other elements, one of them being this disability protection, to come up with my Bulletproof Wealth Strategy. So my Bulletproof Wealth Strategy combines infinite banking with some other things to make it like a fully rounded, holistic approach. And it has really been exciting because the market that I work with are specifically people who are interested in real estate investing and generating passive income. And pretty much the people that are listening to this podcast, I think, would really benefit from understanding exactly how this works. So is it okay if I just go over a little bit about how this strategy works?
No, definitely. Yeah. That's why we had you on.
Okay. Awesome, Lance. Yeah. So let me just ask you this, Lance. Are you totally familiar with the mechanics of a standard home equity line of credit, how that works?
Yes.
Okay. So for everybody who's listening, a home equity line of credit is just where you have equity in your house and you're collateralizing that equity and you're borrowing against that equity. And the bank is saying, hey, we'll give you a line of credit against the equity in your house and we will charge interest for the use of that equity. Now, you still have your house because it's collateralized, and your house could go up in value, it could go down in value. If it goes down in value, then the person who gave you, the bank that gave you that line of credit, might reduce the line or cancel it altogether. It depends on if that line of credit is in first or second lien position. So a second lien position line of credit is obviously more stress to a bank because they have to get behind the primary mortgage holder, whoever's in first lien position. And so a home equity line of credit and what I do are very similar. And rather than getting super complicated, what I like to do is just explain how a home equity line of credit works, and then what is the difference between that and what I do. So what I do is I use this specially designed life insurance, which is only whole life insurance from a mutually owned company. There's only a handful of companies out there that fit the bill of being able to really design these things to where they have enough flexibility to work properly. But basically what you're doing is you're reverse engineering life insurance to take advantage of the tax advantages. That's what I do. So rather than putting in the least amount of money for the most amount of insurance, I flip it and I put in the most amount of money possible for the least amount of life insurance. And you might say, why in the heck would you do that? Okay. The reason is because once money gets inside of a life insurance policy, it is an unbelievable place to store capital. I mean, it's unreal the advantages that it has. It has incredible tax advantages. As long as you don't put in too much money relative to how much life insurance you have, because then the thing turns into what's called a modified endowment contract. Okay, so my strategy is basically built around the concept of putting in as much money as possible for the least amount of life insurance, and then it creates an internal line of credit similar to a home equity line of credit that you can borrow against. Not from, you're borrowing against it, just like a home equity line of credit, you're borrowing against it. And that allows you to do whatever you want. The big difference between what I do and a home equity line of credit is this. When you pay interest to a home equity line of credit, you're paying interest to a bank, okay? They're the people who gave you the line of credit. And that bank that you're paying the interest to, you do not own. Unless you hold a bunch of stock in that bank, you're not going to get any profits from the bank, okay? So that's thing one. Thing two is that your house is not guaranteed to go up in value. We could have a huge housing correction next year where your house goes down in value and that equity line gets squeezed, okay? So that means that they could actually call it and accelerate that line. And if you had the money out somewhere in an investment, then you would have to scramble to sell that investment. So that's not good. And the biggest element is that that home equity line of credit is never going to increase or go up in value unless you go back and get a new appraisal on your house and you requalify financially and you do all of the, what I call the financial colonoscopy of just turning over every piece of information that you ever had. And unless you go back and do that and go through complete new underwriting, your line of credit is not going to go up. Does that make sense, Lance?
Oh, yeah. Definitely.
Okay. So what this is that I create is a line of credit inside of life insurance that is guaranteed to go up every year, guaranteed to expand in your line amount every year. And when you pay interest, this is the cool part. When you pay interest, you're paying interest to an insurance company that is mutually owned. And what do they have to do with that interest? They have to return the profit of the company back to you, and that interest is profit. So they take out mortality charges and company expenses, and then the rest they shoot back to the policyholders in the form of a dividend on your policy anniversary. So it's actually it's a very, very unique strategy where you're increasing and compounding the growth of your policy, and at the same time, you're able to collateralize a loan against it. So you can kind of have your money working at two places at once. Does that make sense, Lance?
Yeah, it does, and hence the banking component, because that's what banks tend to do as well.
They absolutely
right?
do.
Oh, yeah.
Totally. The way that I describe it is, so I like to do hard money lending or privatized loans. You know, that's one of the things that I just did recently, and it's really been fun. So when I do, I just did a loan where a local friend of mine needed $125,000 to rehab a house. The value of the house, Lance, was worth like $755,000. So this is a house that the current value is $755,000. ARV on it's going to be well over $1 million, and this $125,000 was no risk really because of the thing defaults. I easily could sell that because I had the house as collateral. Well, the structure that I did was 3 points down at closing and 1 point per month for 12 months. So that averages 15%. Okay. When you get a 3% bump at closing and then 1 point per month. So if I was using my own $125,000, that's the rate of return I would have gotten is 15%. But because I used a collateralized loan from my life insurance policies, because I eat my own cooking and do all of this strategy myself, because I used a collateralized loan for my life insurance policies, I was able to get that money for 5%. Okay. So the cost of $125,000 to me is $6,250. Okay. And then at the end, actually during the year, I'm going to be making $18,750. So I took what would have been a 15% rate of return. And if you do the math on that and you look at the rate of return between 6,250 and 18,750, that turns that into a 200% rate of return, strictly because I'm using my money like banks use money. Banks do not lend out their own money, guys. Okay. They lend out their depositors' money. That's the thing that I think people miss. And so I try to help people turn that light bulb on and help them understand, hey, they can reposition their capital to use money like banks do, and they can actually increase their rates of return dramatically. Does that make sense?
Yeah, totally. I mean, and that's just it. When you first realize that it's really a racket. I mean, when you look back at, the whole formation of the evolution of the banking system, and I mean, initially when they were able to do that, right? I mean, like some people were just like, dude, that's a complete racket. Like, how can they get away with that? Right? Because that was the whole story. It was like they used to have it like you give them your money and then you had it like, like you had to keep it there and they couldn't borrow it out, and then they let them, basically lend that same money out that you gave them and
yes.
to other people. And so, yeah, I mean, taking advantage of that, it's really the only way to create the same sort of, effect. And so so really the way it works, that you take out this policy, so you've got a premium. It's taxable.
So you're putting in after-tax dollars.
After-tax dollars. So it's been taxed. You're putting it in. You've got a premium. You got a payment that you have to make into this life insurance policy. But
correct.
Like you're saying, the amount of it that's actually going to a death benefit is very little.
Yep. As little as I can get it.
Cash value. Yeah.
Right.
So you can get it. It's cash value. And then as that builds up, then you can basically borrow against it. You said 5%. Is that, it just depends, like who sets the 5%?
Well, okay, 5% is just from one of the companies that I like to use, and they determine it once a year. It's been at 5% though since like 2012. So I'm imagining it's going to be around 5% for the foreseeable future, because that's kind of their floor rate. But again, that you got to look at where that 5% is going. Now, in my analysis of getting the 200% return, I did not count the dividend that I'm getting from the insurance company. So that is just gravy on top. I think if you start bringing that into the equation, it blows people's minds, because they're like, this is too good to be true. But I try to set it up structurally so that people can see, hey, this is what's really going on here, and this is why it works. And the reason that they're guaranteeing you access, Lance, is because if something unfortunate were to happen to you, let's just say that I set up a policy for somebody with a $7.5 million death benefit, right? And they had built up these huge loans during their life of $2.5 million, okay? So they now have a loan balance of $2.5 million and a face value of $7.5. If something were to happen to them, their beneficiaries are going to only get the 5. Those loans are going to be retired by the insurance company. In other words, they're literally guaranteeing the 7.5, so they're obviously going to get their 2.5 back. And that is why the repayment on these loans is not structured. So what that means is that you don't have to pay interest only. So that's why real estate investors absolutely love it, because you can just roll the interest into the future if you want to. There's a lot of crazy advantages that no other financial product really has. I would like to just take a minute and tell your listeners that not everybody qualifies to do this. This is based on your age and your income. And the older you are, the less life insurance you qualify for. So it's a key thing that I have to kind of work with everybody on a one-on-one basis, because by the time, for example, you hit 71, that's basically, there is no more ability to purchase life insurance. There's too much risk on the insurance company. So you want to be doing this in your late 30s to late 50s typically is my average client, but you can still do policies. I'm working with a guy tomorrow who's 68, so you could still do policies if you're a little bit older, but the amount of life insurance that you can qualify for is only based on your age and your income, and then your net worth as well. And the cost of the insurance, Lance, is strictly based on your health. So the portion of it that has to go towards keeping the life insurance maintained is basically dependent on how healthy you are at the time of application.
Yeah, which makes sense.
Yeah.
And then it's, so then, like, if you were sitting, let's just use an example. I mean, if you were sitting on $500,000 in cash,
yes.
How could you get this? How could I get that $500,000 into, like, how would that look?
Okay.
Where do people start? Like, where's the thread? Where's the beginning thread on this thing?
Well, the beginning is that you have to understand, in order for it to maintain the classification of life insurance, they have to pass what's called a 7-pay test. And what that means is, prior to 1986, somebody sitting on $700,000 in cash could just throw it all into a policy, and then they would never pay tax on it for the rest of their life, and all the internal growth on it would be tax advantaged. And it's just like, it was too good to be true for the IRS, right? So they came out with this 7-pay test and said, now you can't put $700,000 in at once. You have to put it in as $100,000 a year for a minimum of 7 years. So you have to stretch out the funding of these things to get the money in. So somebody sitting on $500,000 would not be able to do this and do it with tax advantages and dump the $500,000 in all in one shot. They'd have to break that up over a minimum of 7 payments. Now, the thing is, the policies that I do, the longer they go, the better they get in terms of the ROI, because your cash is just continuing to compound inside of them. So I typically design them to allow money to go in for up through age 67, and then I stop any money being able to go in from age 67 on, and that's when a tax-free retirement income stream starts coming out, and we set that up, and it's just absolutely amazing. So this can be a plan to get tax-free retirement as well. And some of my more sophisticated investors, Lance, use it like this. They'll have a pool of money over here in their life insurance policy, and then they'll have their risk asset. Let's just say it's a stock portfolio or a real estate portfolio, something that could go up and down in value. And if they get to the point when they're ready to retire and their risk asset is really down, then they can pull money from this pool of funds, tax-free, and wait for that other thing to recover. So it gives them this buffer zone of having 2 different buckets of money to pull from in retirement, which is absolutely awesome. There's actually a technical name for this, and it's called sequence of return risk, right? Because as everybody knows, the closer you get to needing to pull funds out of whatever you're saving it in retirement, the higher your risk is of a downturn in the economy. Because if you had, let's say, $5 million shoved away somewhere, and then the market dropped 30%, well, now you got $3.5 million, and you have to start distributing the funds, right? So that would be a terrible scenario. It would be better to have $5 million in your risk asset, $2 million over here in your life insurance policy, than $7 million in risk. That way, if the market went down, you could pull money out of your $2 million in life insurance tax-free, wait for that market to climb back up, and then switch it and turn that income stream on. So that's what a lot of people do.
When you say pull it from the policy, you're borrowing against it.
Well, okay, that's a good question. And the way it works is that you're borrowing against it for doing investments during your life. When you get to retirement, what I do is, because life insurance is taxed on what's called a first in, first out basis, so they call it Fifo Tax Treatment. That means that you can pull your contributions over your entire life out first, tax-free. So if I was going to break this down super simply, Lance, it would be like pretend like you bought $100,000 of Apple stock, and the next day they came out with some new product and it went up to 200,000, right? If you tried to pull out the 100,000 that you initially purchased that stock with, the tax code would consider that capital gains. And it would be short-term or long-term, depending on the holding period. Well, with life insurance, that initial money that you put in, that first-in money, is considered the first out. So you can pull your basis out in retirement without collateralizing a loan against it. You can just pull your basis out first. And then once that is extinguished, then I switch to collateralized loans for all of the gains, and that keeps it tax-free going out for the rest of your life. Now, what you're doing is you're building a big loan that never gets paid back until you pass away. That's all that happens.
Yeah, that's right.
Yeah, and it's pretty cool.
So why do why do you think more people don't do this? Like, or is this the sort of thing that you feel like everyone that should do it, like there's this sort of like, if you meet the criteria and you have the capability and you're healthy and all these sorts of things,
yes,
is it in your mind like it's an absolute no-brainer to do this?
Yeah, I mean, I'm doing as much as I possibly can personally because I understand it. I think the reason that people don't do it is because it's been vilified by financial media, right? Because they literally want you to put as much of your net worth and income and everything else into qualified plans first. And when you can't do qualified plans, they want it in the market. That's just the way the marketing trends go, is they're trying to get every bit of it under assets under management because that's where people make the most money off it. Also, it's been vilified as some sort of a evil fee-laden product. And the reality is, yes, it can be. It can be. If you did a traditional whole life policy like my dad had from the 50s, they didn't have the ability to structure it like this, where you're max funding it with paid up additions and all these things that you can do now that actually reduces all of those fees and increases the relative amount of cash. So there's just there's a lot of negative press about what I do, and a lot of people don't understand it. And I think that's what keeps people from doing it. That's why I'm trying to kind of spread the word to go, hey, this thing is legit. A lot of high net worth people do this, Lance. They have these huge lines of credit available, and then the reason I call myself stress-free planning is because when you need access to that, if a deal comes along that you want to fund, like let's say you come up with an amazing investment opportunity, then they have their money sitting over there ready to go, and they don't have to ask anybody permission to get their hands on it, right? And they're leaving their actual capital inside of the policy compounding, and they're just taking a collateralized loan at a low interest rate to hopefully they would never do this loan if they weren't earning a greater than 5% return.
Yeah, exactly.
It's just that simple.
All the stuff that we're doing is all going to be, so it's basically arbitrage.
It's arbitrage.
That's why I asked
totally.
about the rate. And then so for you, would you recommend, you still tell people like, okay, max, use your max out do you still think that it makes sense to max out those qualified plans first, or is it more nuanced than that? Like,
well,
where would you put the first dollars in? Something like this, or?
It really just depends on the control element. I think that's why the people that I work with really gravitate towards working with me, is because I work with people who want control of their money, people who are putting their money into a traditional IRA, 401k, unless they're doing the special, self-directed IRAs and things like that for real estate, they're really leaving it to somebody else for their financial future. And the people that are into real estate investing generally are more actively looking at deals and trying to understand what they're doing, and they're not just wanting somebody else to manage their money for them. Does that make sense?
Yeah. No, it does. Yeah, and I think that's a good distinction, right? It's just saying, okay, it's one thing to max out your 401k if it's self-directed, then you can at least use it and you get the tax advantage there.
Yes.
But if you're putting it in the hands of some financial advisor who's going to churn it, it's going to basically go nowhere. Then,
Yep.
it's all about how hard is your money working for you. I mean, I think that's what this all comes down to.
It does.
Right? Is that
Totally.
if you want your money working as hard as it can be, implementing a strategy like this makes a ton of sense. But yeah, I mean, if you don't know about it, because once again, like if you're a high income wage earner and you're making like once again, IRS they're gonna get their piece. Like, boom, you made the money, we got to tax it.
Yeah.
Of course, that's why people like real estate too. You're trying to figure out how to reduce, as much of the income as you can from being exposed to taxation. But then when you do generate the cash flow, where do you put it? Right. And so what I'm hearing you say, it's like, that's the beauty of this, is that if you're able to figure out how to generate cash flow and shelter it from as much taxation as possible,
Right.
working as much of it as you can into, a whole life policy like this makes a ton of sense.
Yes.
And then also whatever you've got, just maxing out your 401ks and those, if you're self-directing it, you've got a place you've got something to park that as well. So it's really, it's like lighting it all up can be really, really powerful.
Yeah, definitely. I think the thing that makes what I get really excited about is that when they stop paying any new premiums in retirement, when they're done funding their policy, now they get this tax-free income source, but also, Lance, their dividends continue forever. The dividends just keep churning out of this policy with no new premiums going in. The company just, these companies are over 150 years old that I use, so they're like super stable, and they just crank this dividend out every year that is technically by the IRS considered a return of your initial investment or your return of, premium, but that's only so it stays tax-free. In reality, you've already pulled your basis out, so it's not a return of your initial investment, but I don't know how it got classified as that, but I'm just thankful that it is, really.
Yeah, exactly. So no, totally. I mean, that's the beauty of it, is that it's sitting there and that's how it works. So it's like, take advantage of it.
Exactly. And listen,
what do the dividends kind of look like? I know we kind of said it's all kind of gravy, but like what?
Yeah, the dividends look like, so IRR on the policy over, like, let's say a 20-year period ends up to be, the internal rate of return ends up to be usually high 4s, low 5s. And that, when compared to a risk asset, is not anything to write home about. But when compared to a bank account, which is the closest risk level to this is as close, I consider this to be less risky than a bank account, because these insurance companies, and circling all the way back to the beginning, the reason this ties in with Austrian economics is because these insurance companies do not have banking charters and they cannot perform fractional reserve lending. So if you took a $100,000 loan, they have to reduce their balance sheet by $100,000. And because they're not using internal leverage, that inherently makes life insurance companies less risky than banks. That's why there's life insurance companies out there that have been around for close to 200 years, and there aren't any banks that have been around that long that I know of.
Yeah, no, you got it. That's exactly right. You get to be the bank. They're the ones who don't.
Exactly. This is the strategy. That's why they call it infinite banking. So that's a big part of my Bulletproof Wealth Strategy. But because I also was so impacted by disability and that whole concept, I add elements to the infinite banking policy that protects my clients in the event that they can't work for some reason, by doing what's called disability waiver of premium riders inside these whole life policies, so that not the extra amount that they want to max out with, but if there's any minimum required amount that is due on these things once a year, if you get disabled, the insurance company will pay for it. And the cool thing about it is, it's the one I really like is a company called Penn Mutual, and they have a special one that it's 6 years own occupation, just like the deal that I had where it was just insuring my own occupation. So they'll pay for 6 years own occupation, and then they revert after 6 years to a more difficult standard to meet called any occupation. And once you're disabled from any occupation, that means you really can't work. But own occupation occupation means, hey, I can't be a surgeon, but I could possibly teach at medical school, that's the difference between ONOC and INEOC. Just like with my thing, if I had an any occupation disability policy that I got 20 years ago, yes, it would have been half the cost, but it wouldn't have helped me at all. Because it wasn't that I couldn't work at all, it's that I couldn't do the job that gave me the highest amount of income. See what I mean? Yep. So it was just really important to understand the nuances of these. So I add that element to the whole life policy. And then I also add a couple of other elements, but a big one is the straight up disability policy from a totally different company that specializes in that. And the disability policy pays to age 70, typically, if you get sick or hurt and can't work, and it just, it's just awesome to have that if you need it. It's one of the most under-owned things there is because it's just not sexy, and everybody thinks that they're not going to get disabled. But the truth is 25% of everybody has some sort of event, medically or something, injury, that causes them to be disabled for over, I think, 18 months at some point in their life. So it's a pretty high percentage chance that somebody's going to have something,
Oh, I agree. I mean, these days, they're so good at keeping you alive. I have disability insurance. I mean, like that's just always been my stance is like the chances of me dying are pretty low. The chances of becoming disabled, it can happen because modern medicine is just so great. I mean, before, certain things happen, it takes you down, like chances of death, we're
exactly
much higher.
Well, that's why, Lance, the disability insurance policies are not inexpensive is because people actually use them. I mean, they literally pay out, right? I mean, my policy literally paid out for the full ONOC period, meaning I had a 5-year ONOC. And then once that was done, I had gotten all of this new career together and started doing this. And of course, I kept that original policy. Okay, I went back to paying the $600 or $570 a month or whatever, because once you have one of these things, you never let them go, right? It's just the pricing is from my, 30 years ago.
Yes.
So I kept that original policy even after it paid out. Then after my thing ended up reverting and I had no more income coming from it, I just left it alone and said, okay, now I'm going to start paying for it again in case I need it again. So,
no, it's fascinating.
Yeah.
So how does someone, what does the process look like? So anyone who's listened to this is like, okay, this seems to make a lot of sense. Maybe it's a good fit for me. So when a new prospect comes to you, what does that look like?
Well, I have a very, very low, just a super low threshold for really being able to learn about this. And all people do is go to my website, which is stressfreeplanning.com, and then you sign up for my educational videos, because when I go and speak to real estate investors and other people about my concept and my strategy, I usually record it so that I have this library built up of really good educational material from different talks that I've done to different real estate investing groups and things. And that gives you a very good basic knowledge of how this works. And then as you want to, you could go into even deeper and deeper, because I got some really involved educational videos on there as well. So I've got kind of some high level ones and then some more advanced ones. And then if you like what you're seeing on those videos, there's a button there to book a call to talk with me about it. But I like to pre-educate people first so that they know that I'm not going to be bugging them. And if they don't book a call with me, it's totally cool, right? It's not for everybody, because everybody doesn't meet the requirements. And again, the requirement threshold is not super high. You just have to be insurable or have somebody that you have an insurable interest in, like a spouse or a child, and to be able to qualify to be able to do one of these plans.
Yep.
Super simple.
Yeah, that's great. Okay, cool. So there's anything we didn't cover that we need to cover?
Well, The only other element that I wanted to cover real quick is that sometimes people aren't ready to do the whole life policy, but they have a need for life insurance. So I add another specialty product called a guaranteed convertible term policy, and I do it with a mutually owned company. And what that element does is it allows somebody to just capture their ability to own the insurance, and then anytime over the next 20 years, they can convert a portion of it or all of it to a whole life policy. So I call that my option strategy. And that's a really important element for younger people who are like, hey, I want to do this in the future, and I want to make sure I've got some real high risk right now. I maybe just have a new family that has just started or something. So for those people, I do have an option that can get them started in a very, very low cost, out-of-pocket way. Does that make sense?
No, totally. And that's what I'm a life insurance guy, disability guy. I mean, like, these are things that, so totally. When I started, it was all term.
Yep.
Now, I'm learning that, I never went deep enough to become like your level. So, it always made sense. Whether or not I've implemented it correctly is probably another story. But yeah, and so I'm with like Northwestern Mutual Life, and
yeah.
And then you go to, then you got a perm policy, but this concept, the whole notion of just having the death benefit be lower, like maxing it out, right? Like, that's
maxing the contribution for the minimum death benefit. That's what we do.
Yeah.
Yep.
That's the key.
Yeah. Well, Lance, thank you so much for having me on. This has been great, and I really do appreciate it. I hope your listeners got some value out of this.
Yeah, I'm sure they did. I think these are the things these are like the ninja skills, right? Like, it's not just, it's figuring this stuff out, because to your point, if you can go in and get into some multifamily syndication, just something super simple, and you put in 25, 50 grand or whatever, and that thing's going to basically kick out a 10, 11, 12 IRR over 3, 4, 5 years.
Yep.
Right. And you basically borrowed that money, like you said. That's the same thing. You were talking about basically 15 IRR on a loan.
Yep.
Same thing. 3 points up front, 1 point. That's 15 IRR.
Yes.
Right. So if you can do that, in your case, I guess you were getting probably money that you could. But I guess you were just compounding it. So you weren't even paying the interest on the 5. You're just letting it
go. Yes.
And that cash is all coming back in your pocket. That guy's paying interest on the loan. So same thing. Then you can reinvest that. It's just super powerful.
It really is.
And then you're getting the arbitrage basically between what amounts to a 5 and
a 15.
Whatever it is.
5 and a 15 arbitrage is a 200. So that's a 2x
200.
multiple. Yeah. So 200% rate of return. And listen, my clients are doing this every day. They literally are doing this. They're turning a 15% into a 200%. And when the light bulb goes off, the question in their mind is, wait a minute, how can I get as much of my income as possible through this strategy? Because it's not locking it up and throwing away the key. It's just moving it as a conduit.
Yeah, that's right. And that was why it was the first thing that came to my mind, is like, how does, and then you said the 7-pay deal.
Yeah. And again, 7-pay is just how you contribute the money and how much. Yeah. So the first thing I do, I'll tell you, step 1, Lance, is I figure out how much you can qualify for life insurance. Basically, that's it. Like, let's just say that you're 30 making $100,000 a year. Well, I immediately know that based on your income and your age, you qualify for $3 million. Now the question is, how much money can you put in for a $3 million face value life insurance policy? And that will tell me what kind of deal we can design, right? What I can design for you. So that's the first question I always have, is age, income, that's it. And then the cost of it, or the feasibility of it, determines really based on your health. The more healthy you are, the better the IRR on the whole deal.
Yep.
So
that's good. We're all in control of our health. So
that's it
for the most part.
Yeah.
So, great. Cool. So once again, just share it where we go. Stress-free planning. stressfreeplanning.com, right?
Yeah, stressfreeplanning.com. Just go there. I have multiple places to sign up for free, free educational videos. I even have a webinar that I'm running now that you can sign up for if you're interested in, if you like learning that via webinars as well.
Yeah, very good. Cool. Thanks so much, Tom. I really appreciate it.
Thank you, Lance. Take care.
All right, take care.